Yes, so before I proceed, I would just like to go back to the chart which I shown you, because probably I will change this so that you also know that as per this. Yeah, this is the chart we discussed, correct? So in this chart, probably I will do that change so that I can explain you later. You can find a different thing here when you revise. So I can say something like forex gain on the debtor's loan, operational, non-operational. So if it is an, okay, I will put it like this: operational, non-operational. Non-operational will realize unrealized. Okay, if it is realized, then reclassify, because it's non-operational something, it will go somewhere else. Unrealized, you reverse it. But when it comes to operations, do nothing. Why? Because if it is realized, it's operational and you realized. If it is not operational, it will get adjusted as a working capital adjustment. Ultimately, it will get deducted. If you don't do anything, as a working capital change in the creditor, it will get deducted. Otherwise, you have to state the opening creditor there if you want to deduct it here. Understood? Which one? Under the indirect method. If you have followed the direct method, it would have got there only, it would have got adjusted there. Okay, I can say yes, under indirect method. Okay, probably I will try to give both the examples, try to include it. Are you clear? Now one more question came. Now the gain on forex, whichever is unrealized, restatement, is it not going to OCI as per Ind AS 21? Well, what we are talking P&L here. Again, see, when we talk about Ind AS 21, there are two types of translations. One translation is the situation where you have got one parent entity. That an entity is there which do not have any foreign subsidiary. Another is the parent who have got, and they have got only foreign transactions. Another is the entity which has got foreign transaction and foreign entity subsidiary. Follow? Now the translation what we have been doing, monetary at the end of the year, this thing and all, it is for foreign currency transaction, not foreign currency financial statement. Like if you have got a subsidiary, as per 110, are you supposed to consolidate that subsidiary's financial statement with your financial statement? Is it a foreign currency transaction? It's not a foreign currency transaction. You didn't take a loan, you didn't import a material, you have got a subsidiary. You never had any transaction. What you are doing, the subsidiary's financial statement, that means their trial balance in dollar, you are converting into INR. And then you are consolidating as per 110. Understood? But in these first two scenarios, your parent will have a foreign currency transaction. So what are things we are discussing here, hitting P&L, unrealized, it is foreign currency transaction perspective, not foreign currency translation perspective of the financial statement. Now what goes to OCI, FCTR, foreign currency translation reserve, is the subsidiary's trial balance when you convert into INR. The cumulative difference of all these differences, that amount will go into OCI, not this. This amount, transaction translation, will always go to P&L. Trial balance translation will go to OCI. Are you very clear? Very good. See, this is the way you should think. This is the way you should connect. Then you will be much more clear of what you are doing. Otherwise, it becomes one format. Clear now? Okay, simple thing is, when you talk about gain or loss, okay, I can put it very simple. Maybe in that chart I will show. It can be transaction or it can be trial balance. Whenever you restate the transaction, whatever differences are there, it will go to P&L, which all the problems we have done. A parent entity may not have any foreign currency transaction. But for the sake of 110, you have to translate a dollar trial balance into rupee trial balance. And in this process, you get differences. That difference will go to OCI, which is recyclable. The day you dispose this foreign currency, this subsidiary, you will take it from there to P&L. Again, then you will ask me, sir, what is that cash flow treatment? Academic. Not even a single question is there in entire study material example related to this. So, why we want to get into it? But good. I want you to think, be more clear of what you are doing. Okay? Yes, tell me. Reconciliation will be the same. There will be some differences because of the, which differences? Because of the dollar translation, because dollar is a CC. That only you have to prepare reconciliation. Rest other thing, and we have already prepared two reconciliation. One time we purchased a computer, second time we got an interest. But if you see this reconciliation statement, which reconciliation item was sitting? Only the exchange difference on the dollar, no. Other things will not will not reflect there. Other thing will reflect it here. Do nothing, add it, reclassify, show somewhere. Where? We are telling, no, we are adding back. No, here when I prepared the cash flow statement, I said, no, this is not related to this. This is belonging to something else. That's why, that's one way of presentation. If you don't do in the indirect method, if you don't want to add back, then keep quiet for operational, because it would have been adjusted as a part of the working capital. No, where? At the end of the year, your cash is in INR only. No, did you have any dollar there? Euro was there in your hand. In the previous example question, did we have any euro in your hand? No, it was only a sundry transaction. Reconciliation, whichever you prepared, whichever questions we worked, in every single question, I had a foreign currency in my hand. That translation difference, I will prepare the reconciliation statement. But I have got a foreign currency debtor, foreign currency creditor, foreign currency loan. For this, I don't prepare any reconciliation statement, because that will be part of my cash flow statement only. Understood? Yeah, think over it. Please think over it, students. Yes, I know. The more you think, more doubts should come to you naturally. But that's a good sign, right? Understood, no? So, when we have got, see, okay, I'll show you here. That's why I did the broad classification. When we have got foreign currency related translations, then only we have to prepare a reconciliation, because we get a difference between the cash in hand and the balance sheet. But you don't have this, but you have got only this. Then your cash in hand is in INR only, no Baba. Should it not match with your balance sheet? It will match. Perfect, Shruti? Yeah, think over it. Think over it and please articulate a question and show me. Let us go to the last aspect called consolidation. See, there is nothing difference here. But again, final level, you should learn this forex adjustment, consolidation adjustment, not preparation. Yes, take out question number 10. Now, entity A acquired a subsidiary, entity B, during the year. Now, okay, don't get into foreign now. Foreign we are done. Indian entity acquired a Indian subsidiary. The summarized information from the consolidated P&L and the balance sheet is given to you. So, they have given you consolidated P&L account of both the entities, and in 110 we discussed it is line by line consolidation. Now, consolidated balance sheet also they have given you 2002. When did this acquisition happen? During the year. That means this number must be belonging to the parent without subsidiary. Possibly, because there is no goodwill here. At the end of the year, goodwill came. If you see there is a big jump in the PP, almost double, that means my subsidiary must have got added here. Understood, no? But here, shareholders' equity, what is the meaning of this from 35 to 90? What is that additional? It is what? Shares issued. To whom? Did I take subsidiary share capital? No, because you say, sir, this is 110. What is this? Maybe for this acquisition, I might have issued the shares to the subsidiaries owners, purchase consideration. So this is without B, followed, no? Now other information they have given, all the shares of entity B were acquired for rupees 74,000 in cash. Oh, that means you didn't issue the share capital. Then how this shareholders equity increased, not share capital. That means other post acquisition profit must have come, my profit, everything must have come. So we understood that share capital must have remained same. The fair value of the assets acquired were so and so when they acquired it during the year. Prepare consolidated cash flow statement for the end of the year as per Ind AS 7. So we have to prepare CFS now. Okay, so we'll do one. Prepare working note 1, working capital change. Right, working note 1, working capital change. Write the heading. How many working capital items are there here in your balance sheet? You have got trade receivable is there. You have got inventory is there. Trade payable is there. Income tax payable will come separately. That we will check. How do we say? Because what is going to come is that income tax provision. I told you, no, tax provision will be added back. Tax paid will be deducted. Okay. How much is my change? So first I start with the opening balance. How much is my opening balance? Inventory 35,000. Trade receivable 50,000 and 60,000. On account of business combination, you acquired your subsidiary at a fair value, correct? How much inventory acquired from subsidiary? Because there's a change, you know. Subsidiary inventories, you got 4,000. Trade receivables, you got 8,000 and 32,000. If this was the case, what should have been your closing balance? 39, 58, 92. But what is your actual balance? 30, 54, 68. Followed, no? Opening balances are without B. Closing balances are with B. Now, how much is your change? You have got 9,000, 4,000, 24. Are you going to add 9 or deduct 9? Add. Add. And deduct. Followed, no? The logic. Okay, now let us look into the other items. Okay, change in the PP and other things. Working note number 2. Movement of balances. PPE and long-term debt. Same story again. I start with the opening balance. How much is my opening balance of PPE? 80 and 64. Did you get any values on the date of acquisition? Yes. On account of business combination, you got 1,10,000. Look into that statement, what they have given you. 36. So how much depreciation was charged on PP? 30,000, which you are going to deduct. If you check, this should have been the closing balance now. But what is your closing balance? 1,60,000, 1 lakh. So if you see, there is no change actually. No acquisition happened, no retirement of the debt happened, no new debt you got. Okay, the next one is the equity. Below this, you can write the equity. Opening balance was 35. How much is the profit for the year? Consolidated profit 50, 55. Closing is 90. So again, there is no new issue of the equity. Whatever increase happened, it is happened because of the profits. So you're going to prepare whenever there is a consolidation. First, you're going to find out, okay, how much has come from the subsidiary. And is there any other additions or changes? Now, why we are doing this exercise? If you don't do this exercise, what's going to happen? Now, you say, for example, simple thing. I will say that, how much is your PP? 80. How much is your closing PP? 1.6. So, from 80, you minus 30,000. How much comes to? 50,000. Minus 1,60,000. How much it comes to? 80 minus 30 minus 1,60,000. You will tell, we have purchased 1,10,000 rupees. Did you purchase? See, understand students, here you need to understand one concept here. How the consolidated cash flow statement will be prepared? Line by line consolidation. Their asset, my asset. Their liability, my liability. Followed, no? Now, at the group level, did you spend any cash to acquire PP here? No. You spent only one cash. What is that? 74,000 rupees. From the group perspective, you paid 74,000 to third party. That's the only cash you spent. You didn't spend cash to acquire this 1,10,000 rupees. But when you look at the consolidated balance sheet, 1,10,000 came when? You added your 80, 50, you added their 1,10,000 and you consolidated and showed 1,10,000. But in reality, you didn't pay cash to 1,10,000. Understood the logic of why we are doing? Because every time we used to go with the balance sheet and check opening balance, closing balance. Because if we do that exercise, then we say that I purchased PP, I paid the debt, Arre Baba, nothing you did at a consolidation level. In consolidation level, you took their balance sheet, you took your balance sheet, you added it. If at all any cash transaction happened, it is between you as a group and the earlier owners of your subsidiary. That's why we add it and then we find the net. Because from the group's perspective, that's the net cash payments or received to happen. Followed, no? I hope you understood this, why we did this working note. Yes. So now we will prepare that cash flow statement. Profit after tax. How much is your profit after tax? See, this cannot be discussed at the inter level, no? At the inter level, we can just prepare a cash flow statement. And their mind will blow now. If I bring in, what is that called, Forex there, first of all, Forex, I don't know how they will pursue. Consolidation will look like a demon only there. And we try to sit to explain consolidation, it will happen. They will not enjoy that. See, now, since you have done consolidation, Forex, online students might have done, but you are, at least you got I have explained you. You are able to connect. This is final level cash flow statement. Just it. Hardly how many questions? 15 questions. Spend time now. Master that. Understand that. in and out of what 15 questions we are doing. Okay, now you have got profit after tax. This is a consolidated profit. Now add or less. Look into the P&L account. Which P&L? Consolidated P&L. In that P&L, is there any non-cash expenses are there? Which one? Depreciation. 30,000 add back. Is there any other expenses? See, tax provision is there. Correct, no? Because I don't know. I should deduct tax paid. 15,000 they have given. If it is tax paid, I will deduct it separately. I have shown you one problem. 105, 105. Very beautifully crafted. Huh? Because that was cash tax paid. First problem, Kuber Limited. So you add 15,000. Is there any item which should be shown separately? Interest. Okay, so interest paid. How much? 4,000. Add or deduct? Add back, because it's a deduction. 49,000. Yes. Now let me go to the plus bar minus change in working capital. Very easy. Interest paid. When you paid the interest, what accounting entry did you pass? Finance cost account debit to cash. What did you do? You deducted it from the profit. Since I am following indirect method, interest paid should have been as part of finance activity. No. How can you deduct it from the profit and say cash flow from operations? So your operational profit is shown less. Add it back. Correct? Now working capital change is now nothing. We have already done one working note now. So how much is inventory? Add or minus? Already we have stated there, 9,000 add. Debtors, 4,000 add. Creditors, 24,000 minus. How much tax did you pay? So net is 11,000 minus. Did you pay the tax? How much? 14,000. You see, here you get that impact. Okay, first of all, how much you are debited to P&L account? 15,000. Go to the balance sheet and check, is there any deferred tax? No, because if deferred tax was there, this 15,000 what you debited to P&L account, there are two components there. One is a deferred tax component, another is your P&L component, tax component. Deferred tax will only get added back because it is a non-cash. Again, less you don't do. Now, when it comes to the tax component, go and see, is this provision sitting in the balance sheet? Okay, what was the opening provision? 11, add this 15, and what is the closing provision? 12. So, you must have paid 14,000 cash, no? And this concept you learned where? Not in that first problem. Huh? In one consolidation problem, you learned this concept because there it was half. Kuber problem was not clear to you. Why? Because that type of challenge was not there. But they introduced deferred tax there. So now you learn, oh, deferred tax and this tax, as per Ind AS 12, both will sit in one place. So next time, if they mix you, in the same question, one deferred tax asset comes, you know it, you have to give a breakup, add it both, but the deferred tax you don't deduct it. Perfect, no? Now it will sit in your mind. Now you say, please test me. See, deferred tax, we just add back because both the taxes would have been sitting in the tax provision as per Ind AS 12 because we have to give two taxes. So we have to check if the deferred tax movements were there, just add back that or deduct it, whatever it is. Deferred tax expense was there, deduct. But this tax provision balancing figure you should see, is it sitting in the balance sheet? No, then it is fully paid. Yes, then do this activity and get what you have actually paid. So you have got cash flow from financing activity, or operational activity. Now write cash paid to subsidiary, or you can write the heading cash flow from finance, cash flow from investment activity. Write the heading. We are done now. Operational we are done. Goodwill is a non-cash, no? Yeah. It is not going to come. Okay, now let's see cash paid to subsidiary. How much did you pay? 74,000. But you remember one theory we discussed initially. If you paid a cash to the subsidiary and on that day there was some cash balance sitting in that subsidiary ledger, you minus subsidiary cash. This is the presentation. So what you actually paid was 72,000 from the group as a whole. You might have paid 74,000 to the owners, but at the subsidiary level there was some cash. Which one? How much? Wait, how much is the opening cash here? No, see this impact to analyze. No, we have to go to the opening journal entry there. That's why goodwill we are ignoring here, because when you have taken 74,000, okay, so 74,000 is a goodwill entry. No, there's one goodwill entry sitting. That's why if you have to analyze academically, we can sit and analyze, pinpoint where it went, what happened, which net assets came. Okay, but if you see at the end, the balance sheet is going to tally, the cash flow is going to tally. So you are okay, and was there any interest paid? You have given one leg, no? You deducted, added it back. You deduct your financing activity. So now your net cash flow from all the activities will be 3,000. Opening cash and cash equivalent will be 5,000. And closing cash and cash equivalent will be 8,000. Now, from the statement, did we consider all the assets and liabilities? See, inventory was there, trade payable, cash, property, trade payable, long-term debt, goodwill, cash consideration paid. See, now the goodwill entry, goodwill is not going to come here because again, you added so many things, you deducted. You added no one entry here. Goodwill entry actually you added by deducting 74,000. What came to you? Their assets came to you. That's why when you deducted the working capital change, here in this working capital change, the net assets on that day you removed, no? So it is sitting there. You deducted. Otherwise, what would have happened? No, you would have shown more cash paid or to acquire the assets or something like that. You would have shown. You would have shown PP purchased and all. Where did you show PP purchase here? Did you purchase any PP? No. Instead of that PP, you paid one single sum for all those assets. PP, loan, inventory, stock, debtor, creditor of subsidiary. Are you clear about this? By telling this 74,000, you are telling, look, individually I didn't buy. From the group perspective, all are with me. Okay, no students? Yes. The next question, this question came in your November 20 examination. See, in cash flow also 3 questions have come. This is a bit confusing, no? That's why they asked you this question. And see, high probably, as far as I believe, this must be a simple repeat question, a procedural question. Why? Concept is difficult there in the study material to understand why we are adding it, why we are minusing it, why we are not taking subsidiaries goodwill. All this question would have come to the students. That's why they have given as it is, assuming that you must have understood it. Okay, students, so please pause the video, do this working, let us compare the answers. Yes, students, so before we will check the answer, but before we check the answer, yes, I just updated the chart book also. In the chart you are going to find, when you are revising, no, you will find something like this. I have told that the tax provision will be added back and tax paid in cash will be deducted. Deferred tax only adjustment to PAT happens, but no deduction in the non-cash. Say for example, your profit before tax is 1,000. You deduct tax expense, income tax provision 150, deferred tax expense 50. So how much is PAT? 800. But if you see now, balance sheet, you made a provision of 150. Already there was an opening provision, but the closing provision is 100. That means you must have paid how much? How much is the cash payment? 50 plus 150 minus 100. 100 you must have paid in cash. Deferred tax, there was opening balance was 0. Closing, you made a provision here. Now look, if assuming, okay, if this is my cash profit, taking all this income tax adjustment, what is your net cash outflow or inflow? You say, sir, I made a operational cash of 100,000 rupees minus I paid income tax of 100, 900 rupees is my net cash. Followed, no? Because there are only one cash item called payment of the income tax. So if I go to the balance sheet, I will show PAT 800. Add back the income tax expense. When I add back, I will add a tax provision also, deferred tax also. But when I separately deduct income tax paid in cash, I will deduct only how much I paid in cash. So ultimately it comes to 900. So this will be part of my deferred tax will be added back, but again not it is deducted. I hope it's clear now, this particular concept. Okay, so I'm just thinking that foreign currency of the debtor creditor. Okay, I can do that. Now I'll present it separately so that anyhow, since now you have solved the problem, you know the two different treatment. Yes, now we will move on to the examination question which I asked you to do. Is it the same question? How many marks? 8 marks question. Okay, so what you need to do, I don't think so any other thing, any other adjustment was there. 37, so 74 divided by 2, just half the numbers here. First you start with the change. 4,500 is your inventory change, trade receivable change, trade payable change. Did you get this number? Yes, this is a very simple thing. The same previous question. Movement in balance of the PP and long term debt was not there. If at all they would have twisted and some balances would have come, you would have said as per investment activities or as per finance activities. Why? Because group as a whole, you took cash from third party or you paid cash to the third party, you purchased asset. Then equity, there is no change. If at all issued, it would have been a non-cash expense. You didn't get any cash or you should have seen. So PAT 27,500, depreciation you will add back, interest show separately, tax provision, change in the inventory. So did you get cash from operating activity 39,500? Any mistakes here? What mistakes? What went? Calculation mistake, not acceptable. Any conceptual mistakes? Anybody forgot? Any? Okay? Yes. But then you would have found it out, no? At the end. Okay, so exactly that amount was matching. See, this is a bad luck because their exact amount to match with 1,000 rupees. Calculation mistake and it's very coincident. So 36,000 interest paid and you got the closing cash balance of 4,000. See how beautiful, how fast you can do this. Previous slide. Any other mistakes happen here? And you understood, no, why we are doing like this? Because we are doing consolidation level. I paid only one cash of that 37, that's it. And goodwill I didn't consider because that 37 and PP, everything is sitting there as one item. So this way you do it. Yeah, again, I can sit with that reconciliation exactly to show you. You can leave it. So much time you have spent here. Okay, are you clear? Sorry? I didn't get you. What? Sorry. Decrease in receivables. How much did we put there? Yeah, decrease in receivable, my opening balance was 25. Acquisition you got 4,000. Closing 29. Closing 27. So 2,000 is the increase, no? When the debtors are increasing, you will assume that cash has been paid. You are telling negative balance. Yeah, 27. Closing is 27. No, yeah, correct. Closing is 27. Debtors reduced, cash came in. Yeah, correct, no? If I go back to the statement, see, this is my debtor statement. Opening was 25. Closing is 27. You would have straight away said, so 4,000 came. Okay, not 24,000. This 2,000 came. Okay, but out of this, sorry. You got 2,000, no? and decrease payable. So for this, no, what was your opening? 25. Did you get this 29? Now your opening was 29, closing balance in the closing balance sheet is 27. So your debtors got decreased. It is numbers are nicely crafted. You see, exact 25 to 27 is also 2, 29 to 27 is also 2. So what you need to check is 29 to 27 you need to check. You must have compared 27 to 20. Then it will the same number. No, you will get confused. You cannot compare 25 to 27. Why? Because in between that 4,000 came. No, otherwise, in fact, you say I got like what is it called? I paid money to the customer. No, your customer balance got reduced. That means you got cash from the customer. How much? Only 2,000. Otherwise, you would have said instead of cash received from customer, you say cash paid to the customer. Arey Baba, there is one combination happening and 4,000 customer came from there. No, whom you paid the cash there? Nobody. So net effect is only cash received from the customer, 2,000. Are you clear? Yeah, I hope this part is reasonably fine. Next question, please mark this question very important. Not new syllabus, no? Because there are some adjustments here. The relevant extract of the consolidated financial statements are given to you. Oh, they gave you the consolidated statement of the cash flow only. 1 minute. Is it what a balance sheet or cash flow? No. But it is a balance sheet. Study material question. No, 5%. Don't trust study material questions. Don't go with the study material question. Look at the solution. Okay, so first only they try to put one Yorker. Okay, and when they put Yorker, you understand it is Yorker and just don't try to hit 6 there. Chances of getting bold is very high. Understand, that's the skill. Okay, so leave it. So they have given you the balance sheet last year and this year. Extract of the consolidated statement of the P&L account they also given. Now the above information is relevant for the A Limited. A Limited spent 30 lakhs on renovation of the building. Now the A Limited charged this entire renovation cost to the P&L account. Oh, that means somewhere in the operating expenses, you have got one item which is mistake. What it should have been? It should have got to some PPE, but you made it debit to the expenses. So it's an investment activity as such. It's coming as an operating expense. On 1st April 2011, acquired 100% of the share for 300 lakh cash. They have given you this net assets. You understand what to do? Means the closing balance sheet is, if you look at the closing balance sheet here, this closing balance includes one investments here. Okay, now you invested where 100% of the investment of the S Limited. Yes, obviously, as per 110, S Limited investment will not come, but their net assets will get added to your net assets. Followed, no? So at the end of the year, already the net assets are sitting there with you now. Now A Limited's property, plant and equipment comprised the following thing. Carrying amount on the beginning of the year is 4,650. Just check how much is there. Yes, same 4,650. Addition, including assets in S at the cost, including asset in S Limited. How much is the asset of S Limited? 140 plus a proper additions. Proper additions. That means you really acquired. See, when you say closing balance is 4,750, you say the difference between this and this is new additions. This plus depreciation minus closing is the new addition. But wait, at the group level, entire amount is not new addition. Something is coming from subsidiary for whom you paid the cash to the owners as one investment amount. They said 800 is the total addition, which includes 140 coming from the subsidiary. And balance amount will be the genuine purchases. Revaluation surplus came here. Oh, that means there, when there is an increase, there is one non-cash item of revaluation surplus. None of the problem we came across. It's not NSB, no, new syllabus. It was there already. Now disposal, sale of assets you did 490 and depreciation for the year is 290. After this you got the closing balance of that PP. Now you are very clear about what that balance of the PP is all about, what all things it is made up of. Now A constructed a machine, that is qualifying asset, and incurred a construction cost of rupees 40 lakhs. That has been charged to other expenses. What they should have done? PP, as per Ind AS 23, this qualifying asset, they should have capitalized or capital work in progress. Do you see anything capital work in progress there? No. No, it must be part of this only somewhere. Of the interest cost of 110 lakhs charged to the P&L account, 10 lakh is the interest on the specific borrowing cost. So this construction cost is part of your somewhere addition, but you missed this 10 lakhs, which should have gone to the part of the PP, but you have added it to the other operating expenses of finance cost. Two mistakes we found. Property, plant and equipment was sold for 630. The gain on disposal is adjusted against the operating expenses. A constructed a qualifying asset incurred. That means there are two mistakes. First of all, this 40 lakh should have been part of your this or CWIP, capital work in progress. Both are same. You say capital work in progress or UPP, it's an investment activity. But what they did, that expense also they charged to other expenses. Interest was there, you should have added it to this work in progress. That also cost you charged to the P&L account. All three mistakes now. Blunder after blunder. Now property, plant and equipment was sold for 630 lakhs. But what you are telling here, 490 lakhs. This is at its book value. This is the sale value. What the profit element, what they did? They took it to the adjusted against operating expense. That God knows, Papa, what accounting they are doing. You would have fired, no, this guy, if you have seen him in audit. Left and right, no, you would have been very happy to note down all this, your observations. And one discussion you would have said, what nonsense accounting you are doing, this, that. Fine, you would have, okay, everything is fine, then what audit you have done? Okay. A Limited purchased 30% interest in the associate on 1st April. In days 28. Why? We are into CFS now. We are not preparing cash flow statement on a standalone basis. That's why you see that in the balance sheet, investment in associate as per Ind AS 28 actually at the beginning of the year. How much? 30% interest. And they associated reported a 400 lakh rupees profit and the dividend of 100 lakhs. So what is the closing balance? You see investment in associate is 800 at the end of the year. Beginning of the year was not there, but how much cash did you pay? Question is clear, no? In the cash flow statement, if you go look at the balance sheet, opening balance of investment in associate is not there. At the end of the year, you have got 800 rupees paid. Now, they didn't tell you how much cash paid to acquire these investments. But they said that associate earned 400 lakh rupees profit and they paid 100 rupees dividend. Call back your knowledge of Ind AS 28. Do one reverse working and get your cash balance at the beginning of the year. How much cash you paid? Where they have given? $300 lakhs, sorry. There is a change in the question, any number is there? This is 100% of the shares in S Limited, subsidiary. There are two investments. One is investment in subsidiary, one is investment in the associate. In the consolidated balance sheet, will you find, in standalone financial statement, if I would have seen, you would have seen two investments. Investment is as per 27. But since they gave me a consolidated, they call it cash flow, but it's a consolidated balance sheet. There is only investment in associate is going to come as per Ind AS 28. Why? because the investment in subsidiary is going to get eliminated and all the individual assets will get added there. Are you clear now, Dhanshu? Which one? That is, no, see, in the closing balance of investment in associate is 800. 800, no. This came how? Opening balance plus share of profit minus dividend, share of dividend or dividend received. That gives you closing balance, no. Now, in cash flow statement, investment will come or investment in investment is going to come. How much you have invested, that is going to come, no. How much you have invested? Did you invest 800? No, you invested some X amount. So, you have to do one reverse working and get that amount of investment you have done on day one, because that is your cash outflow. Followed, no? And this is not a cash item which has got credited to P&L account, your share of profit, but this is a cash item, dividend, but it is an investment activity. The impairment test also was conducted. Very good. L3 level means this is called L3. Impairment test was conducted on 31st March 2002 for whom? Associate or subsidiary? Subsidiary, because associate's goodwill is subsumed in that investment value. You don't separately show it. Now, the following impairment loss of goodwill is 265. Is there any share to NCI? No. Why? You are, with the grace of God, they acquired 100%. Otherwise, I should have broken my head what it is crossing up applicable. Anyhow, just for fun, I told. Goodwill impairment loss is 265. But it is a non-cash expense. But you would have debited to P&L account. Consolidated P&L. Now, intangible assets impairment loss is 900. That means you must have incurred one big impairment expense. Grossing up is not, all those concepts not required, but when allocation happened, you must have allocated to the goodwill first. Is there any goodwill balance at the end of the year? No, that means 265 must have been the goodwill on the day you acquired. When you acquired this 100% of the subsidiary, 265 must have been the goodwill. And at the end of the year, you killed this goodwill. That's why this goodwill is not shown in the balance sheet. In the previous two questions, you found one balance of goodwill in the balance sheet. This time you don't find any goodwill. Why? Because you impaired and you charge that impairment loss first to the goodwill as per Ind AS 36. And balance you allocated to the intangible assets. Intangible also must have gone. Now, it relates to 100% to the subsidiaries only. Leave it, doesn't matter. At a consolidation level, doesn't matter. Both. Now, assume that the interest cost is paid in cash. Now, I say, realized when you are reading this question, your mind must be going in all the directions, this direction, that direction, what they are expecting me to do, if this is going to come in the examination, how much time I should do, should I touch this, all this strategy. That's why they said, you are required to just calculate cash flow from operations. That's it. Don't need to get into that all other investment activity, cash opening at the beginning. Not required. Followed, no? You just find out cash flow from operations. Okay. So first thing, we will check the working capital change. Yes, can you do this working capital change, students? Easy, no? Yes, students, so please pause the video and do the working capital change. Yes, students, so we'll compare the answers. See, after I solve this, not after I solve this, after you solve this problem, you will wonder, sir, what is this question? This is nothing. Because I am not going to solve this. Step by step, you only will solve this. First, did I solve this? No, you only solve, no? Did you get this number? 410, 582, 110. Because your opening balance of the inventory was there. Acquired on combination minus closing balance. Net change is 410. Trade receivable, trade payable. Is there any other item of working capital? And why did I do this? Because I am preparing cash flow from operations. Is there anybody made any mistake here? No. Because I don't expect that you should, because already we have done so many problems, we discussed the concept why we are doing this. Otherwise, what type of cash flow statement I am going to get? It's the misleading cash flow statement telling that group level I paid to the debtor. Which debtor? It is within your group only. I hope you are clear. Everyone got this? Yes, students. Now, pause the video and just tell me one thing. The profit after tax which you would have started, otherwise now you would have started with profit after tax. Is that profit after tax is valid, correct? No, so many blunders are sitting, no? As an auditor, you would have asked to rectify it. Can you tell me the rectified, revised profit after tax or profit before tax? Because tax element is not there, no? Is there a tax element there in the P&L account? No, profit before tax. I want you to tell me revised profit before tax, correct profit before tax. Yes, students. So please pause the video and calculate the revised profit before tax. And this we need for the cash flow statement. Because when we start with the profit after tax, we should start with the right profit after tax. See, why I am asking you to do, again, clear, no? Because this type of question may come from nowhere. You think, think properly, you can do it. So, did you everyone start with 1840? And first of all, why we are revising? Because there is a mistake. Otherwise, cash flow statement makes meaningless there. In the cash flow statement, you start passing rectification entries. No. Prepare cash flow the way it should be prepared with the correct profit. Did you add the renovation cost? Why? Because your profit was less because of the over debiting. Construction cost was charged as an expense. Did you add it back? Borrowing cost, which was supposed to be capitalized, you charge it as an expense. Done. 1920. No? Or tell me. Sorry? Huh? Gain on disposal, what accounting entry you should have passed? Tell me. Which one? Okay, have they told you the life? Have they told you the depreciation percentage? That is not the way, no. No. I understood. You said that on this additional depreciation should have come. Very good. Your what is that called? Explanation is correct. But my point is, on this additional depreciation should have come. But when this mistake happened, at the beginning of the year or at the end of the year? Okay, wherever it is. And will you charge depreciation? Is this work complete? No, is this construction work is complete? On CWIP, will you charge depreciation as per Ind AS 16? You will not charge, no? Yeah, now let me answer. Okay, profit on sale. What accounting entry should have been passed by the accountant? Okay, let us go to the rectification. Bank account debit to PPE to what? You should have gain. But what did he do? To operating expenses. That means he reduced the operating expenses, no? Because of the reduction in the operating, reduced the operating expense. Because of this, profit got increased. So deduct, you deduct operating cost on the sale of machine and then add operating cost on sale of machine. What is your rectification entry? Operating cost to gain on sale. Net effect is same, no? Understood, Baba? Are you clear? If it was loss, it would have been within one net or the other. Ultimately, see, point is simple. Should it go to P&L account? Should it go to P&L? Has it gone? Gone. So, if it's just a matter of presentation. But these items should not have seen P&L account face. But this guy brought it into P&L account. So, this is going to affect your cash flows. Chalo, worst case, it is completed and it's the PP only. Forget not renovation. It's the PP. Have they told you life? Have they told you percentage? No. So my suggestion, because none of the problem till now, when they have not told me life, we don't charge the depreciation. So proportionate to the book value and all that exercise, we will never ever do for any of the problem. Just leave it. Have we come across single problem? We'll take that exemption. When ICA themselves are not done, we will not get into any proportionate depreciation and all. Forget, no? Nice, Baba. You see, you're doing mistake now. And do you think it's a high probable question? Simple question like anything. Okay, next thing again, I'm not going to do it. Prepare a cash flow statement. What is the logic? You go with the profit before tax. Look into the P&L account. Is there any non-cash expenses? Then look into the P&L account and say, is there any item which should be shown separately? And do the working capital adjustment. Finish. Yes, students, so pause the video and do this. Yes, students. Now tell me, how much did you get the cash flow from operation? 2,365, you said. Very close, okay. 2,135. 2025. 1,800, 310, 1,200. Come on. One person. Nobody, no buyer for another. No two people are having same consensus. Answer. Okay. Let us check. Eager, no? Yes, here. Aditya, you got any number? Dhanashree? Didn't get number? Too big. Okay. Let us first see. Have you taken correct profit after tax? Yes. See again, none of the concepts are new. That's why I am telling you to do it. And again, after this, you should go back to the question and say, is there any question which I have not explained to you, which you have got a doubt? Did you add back depreciation 290? Non-cash. Did you add back goodwill impairment 265? Why? What accounting entry you passed then for goodwill impairment? Did you take that goodwill impairment to the balance sheet or P&L account? What is the accounting entry? Impairment expense account debit to goodwill. That's why goodwill you removed. Impairment expense, where did you take it, Baba? P&L no. Should you not add it back? Now, again, we will not, because it looks complicated. If you want me to talk about grossing up and all, then all those aspects will come now. Remove only your portion of that grossed up value and all. Leave it. This is a mistake for no reason. That means you didn't think about the journal entry there, or you left that item altogether. Impairment of intangible asset, did you add back? It's the same treatment now. But when you remove that intangible asset from the balance sheet, then where it went? Then it should have come as one investment item. So you should have removed, add it back. Profit on the associate, did you remove? What entry you passed for the profit of associate? 400 is that associate made a profit. Did you pass an accounting entry as per Ind AS 28? Investment in asset account debit, in associate account debited to P&L? As per Ind AS 28, did you pass that entry? Did you receive any cash? No, is it not a non-cash? Profit on sale of PP, did you remove this 140? Why? Because it should be shown along with the sale proceeds in the investment activity. That means we are done with the non-cash expenses here. I don't have any other non-cash expense. Interest expense, you showed 110, but 110 you passed one rectification entry and removed this 1920. So your actual interest expense is 100, which should be shown somewhere else. Done. Then my working capital changes 175, 2095. Dividend is where dividend is? Has it hit your P&L account? Come on. When they paid you that your share of dividend, what accounting entry did you pass? Did you pass as per bank account debit to P&L account as per standalone financial statement? Or did you pass bank account debit to investment account as per Ind AS 28? If you have passed a bank account debit to investment, it has not hit your P&L, no, Baba. Revaluation, what accounting entry did you pass for revaluation surplus? PP account debit to revaluation surplus. Where did you show that revaluation surplus? In P&L or OCI? What did you start with? Profit after tax? No. Does the profit after tax has got impact of that? If you had made a mistake that revaluation surplus was already, instead of showing revaluation surplus OCI, if you would have put in P&L account, then this figure you would have adjusted in the previous correct profit. By mistake, revaluation surplus, instead of taking to OCI, you would have adjusted to P&L only. You would have adjusted in the previous step. Maybe in the examination they may twist one more mistake of this accountant. No, there is no. That means it was never part of your profit after tax. This is how devaluation surplus you are going to adjust. Please look into the question back and ask me the doubt. I want you to every single number to understand why we are doing it, why we have considered, why we are not considered. Yeah, if you would not have asked, that explanation would have missed from me. You asked me, sir, where is revaluation surplus? Now you are clear. Where is revaluation surplus? Revaluation surplus won't come here. If you talk about the cash flow from investment activities, revaluation surplus would have got added back there or deducted like whatever to cash flow from how much actually you purchased in cash. That's why they didn't ask you investment activity. Is any other item? We have to assume that because that's why they don't give you. If you look into the Kuber Limited, and profit and loss account only they didn't give, but they somewhere said in the adjustment, no. So we have to assume that this depreciation must be sitting in some COGS or operating expenses. Are you clear? Simple, no? Easy question, right? Probable? Highly probable. As it is. So don't worry. Okay, now you ask me one more question, sir. What if I had to do investment? I tried to do it, okay? I could not do it. Because see, again, for this number should match. If I had to do, worst case, they give proper number and say prepare cash flow statement. Do up to here, leave some space, go to the next question. If time permits, you do later. Because by now, you would have scored a majority of your marks. Okay, then you start plotting some numbers. Now, what are things you know? Try your luck best. But up to here, no luck. Up to here, it is your choice, your knowledge, your preparations. After this, in Kannada, we have Palige Bandadu, Panchamrata. If you get, well and good. Didn't get, leave it. Revaluation negative was there. Yes, very good. I want you to have this discussion and think. If it was a revaluation negative, it would have hit my P&L account. You would have just added back telling non-cash expense. Very good. Same statement for impairment loss. No? See, in exam, they may give you an evaluation negative. Please be careful. Chances are very low. Because this question is complicated, chances are very low. ICA is really compassionate. They think a lot about you. ICA is like a parent, no? We are like kids. They think that, okay, we should not trouble you more. And proof I am giving you. Okay, but very nice. Think that if at all they twist there somewhere, please add it. Okay, so we'll move on to the last question. I don't think so I should read also this question. So I can think that you should be in a position to solve, because actually this is not a question should be here. This question I should have plotted solved at the beginning. Is the direct indirect method, that one. Okay, so they are asking you, show the cash generated from operating activity using direct method. Have we done this first? Okay, so I hope you can do it. Trade receivables include an amount relating to credit sale and credit purchase only. Okay, that means full opening closing balance you will check. Foreign exchange loss represents increment liability of a long-term borrowing due to exchange rate fluctuation between the acquisition date and the balance sheet date. Okay, so they said foreign exchange loss has been debited to P&L account. It related to what? Into a liability of a long-term borrowing. So what you are supposed to do here for this liability? ₹18,000. Okay, so what they have done. Anyhow, we will do this question. Okay, maybe see in examination they simply asked you to prepare here, but in exam they may ask you to prepare ledger accounts, because they have presented in a ledger accounts. Alternatively, if the question is just like this, you can have a choice. Okay, first thing we will start with the calculation of purchases, because they asked me direct method. No, in direct method I cannot say profit after tax. Okay, in this question they have given me the balance sheet extracts, and they have given me the profit and loss account, cost of sales, income. Okay, there is nothing, no special items there. Okay, how much is your purchases? Can you tell me, students? What is your purchase? We have done this. Opening stock plus purchase minus closing stock gives you COGS. 55, 55. So what is purchases? It is COGS. How much is COGS? 56 lakhs plus closing stock. How much? 1.2 minus opening stock 1.65. $55, $55. Are you clear? Simple, no? See, they have presented it like this. Cost of sales is equal to opening stock plus purchase closing stock. So if you want to find out only purchase, then or you can write the equation like this. Purchase is equal to COGS plus closing stock minus opening stock. Yes, now to prepare direct method, I told you two things. One, if the mark is very small and if they ask you entire cash flow statement, on the face of the cash flow statement only in the brackets you do the amount. What did they ask you here? 8 marks question, and they said cash flow from operations only. So prepare working note number 2, cash paid to creditor. Understood, no? Otherwise we would have done this on the face. Now what they have done, they have prepared the ledger account of the creditor. So you can do that also if you want. Otherwise you can start with the opening balance 2,15,000, add purchases, working note number 1, minus closing balance. Followed, no? 1,95,000. So we will do it in this format because question is very silent about the format or the way to do it. They have followed one method, one place. Some place they have, I showed you, no, working notes. First, I should have placed this question there. But in the suggested answer of the RTP or the textbook, they have prepared the ledger. One and the same, no. That's a tabular presentation. In ledger account, this is the balancing field. Are you clear? Now, like this, I want you to find out how much cash from customer, tax paid. 2 more items. Yes, students. So pause the video and do the calculation. Yes, students. So we'll check the answers. How much is the cash received from customers? 1 lakh, 85 lakh, 33,000. Opening customer plus closing. And they said what? One more thing. All are cash and credit sales. Credit sales and credit purchases. That means cash sales are not there. Otherwise, you would have added it. We understand what to do. Because when you said sales, they said it's all credit sales. Next, income tax paid. You will go to the opening balance plus P&L adjustment 95,000. Okay, your P&L has been hit by 95. Closing balance you minus 1,12,000. Provision we are making. In P&L provision goes, no? Done? Yes. Next is the cash flow statement. Under, see students, direct method. Yeah, maybe probably I must have placed it here just because there is one forex related adjustment. All time we were doing that, do nothing, reclassify. That is meant for what? Indirect method. If you follow indirect method, then you start with the profit after tax. Then all those forex related adjustments are going to come. If you follow direct method, just ignore it, no. I think Shruti, you followed the direct method somewhere in one of the, you said no. You ignored it, correct? Yeah, ignore it. You don't consider only. Simple, right? If you follow indirect method, the profit is included all this adjustment, not to adjustment. Follow direct method, leave it. Maybe probably this, that's why I might have done this last. I was wondering why I placed this. Okay, so you start with what? Operating activities, cash flow from operation, cash flow from operations. From cash flow from customers, how much? 85, 33, 000. Less cash flow paid to creditors. 55, 75. Maybe in the inner column you can write, or outer column also you can write. For creditors, how much you paid? You can write working note number 2. Is there any expenses you do incur from the operations? Selling and administrative expenses minus admin cost. How much? Full 15 lakh 40. Why? Because you don't see any item in the balance sheet. No. Outstanding, payable and all. Do you see anything in the balance sheet? So you debited admin and selling cost so much. If you would not have paid, at the end of the year balance sheet you should have seen. So let us go back to the P&L account again. Sales, yes, we have considered instead of sales, cash receipt, instead of COGS, purchases, or payments. And to do the payments, I wanted purchases. Interest income will I show? No. If I would have gone to indirect method, deduct and show separately. Leave it here. Fire insurance claim received. Now one question came. In this theory question, what we discussed so many theory, first, whether it is an operating investment. Only one question we didn't came across. Fire insurance claim received. Under which category I should put? Have they told you anything on the fire insurance claim? Question is very silent. Now this fire insurance claim received, is it an operating income, investment income or financing income? Okay, chalo, you take. Stock is destroyed. Stock is destroyed. Operations. Building is destroyed. Operations. You say investment activity. See, Baba, building maintenance expenditure on the building. What it is? Operations. Then you got the insurance claim on the building. See, it is an operational. It is not an investment income for you. You didn't sell that building. It happened. It is in the course of ordinary course of business. This happened. So you say add insurance claim. Yeah, building. See, again you consider that whatever claims you received, you are holding it for the building. Okay, maybe we can have one more assumption. It's a subject matter because it's like a sale proceeds or scrap value, we can say. Anyhow, in this insurance claim, the question is very silent. We may assume to be stock. Why? Because the solution they have done it to be part of your operation. So how much? 1,10,000. Yes, students. Yeah, there is one argument on that. You can say that insurance claim on the building may be part of your sale proceeds. You can treat it like this. But the question is very silent about the insurance claim. We can give a note. Now, is there any item depreciation should I consider? No. Why? Because I am following direct method. Administration we considered. Interest expense? No. Direct method. Foreign exchange loss? No. Direct method. Otherwise, all these things would have got added back there. Income tax? Yes. Less tax paid, working note number 4. How much? One lakh to 1,12,000. Now go to the balance sheet. See, working capital adjustments will come here. No, because already considered. No, in your direct cash received from the customer, I have considered the working capital. So all working capital adjustments are not going to come. So ultimately, your operational activity will be 14,16,000. Yes, only one. What is that called? Your confusing item here is the fire insurance claim. If it would have realized from operation like foreign exchange loss, no. This foreign, okay, even though if it is realized, it is on what? Here no. If it was a foreign exchange loss or gain on the debtors or creditors, yes, it would have been part of my direct action. Yes, very good. Understood, no? No, so by asking more question, by thinking more, see, you are making yourself stronger. You are thinking, we are not touching everything, but whatever we touch, let us understand it proper. Clear, students? Cash flow confident? You can do, no? Yes, please practice this. Thank you very much. So we can move to the next standard.